Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap that we do here each and every night on the membership side of our blog. We had a pretty light day today with just two opening trades. Had a lot of orders that were working, but just only two that filled in here today. It was actually a pretty active day. I mean, the market opened up a little bit lower, and then it dropped, and then it rallied, and then it dropped, and it seemed like it was going to close kind of at the lows of the day, and then right before the close, it rallied back up to almost near neutral on most of the major indexes. So very much a very undecided day that both sides are really tugging hard, and it's likely to see either at a point where the market's going to peak and roll over, or we're going to just stay here for a little bit until we gain some additional momentum and continue higher. So today we had one trade for March and one for April. Now the March trade is the one that went in first, and for those of you who are members, you saw that we also added email alerts along with SMS text alerts today. So the alert for Facebook did not include the word debit on there, and I apologize for that. It was just a bug that we had to quickly correct, and we could only really try out here today with the first alert that went out, but it is correct that the system should be working to send out these text and email alerts to everyone who signed up for a membership. So you'll get both, and you can use both as you wish. But it didn't have the word debit on there, so I apologize. But the Facebook trade was a debit spread. It was a debit call spread. We bought the 70s, sold the 72.5s to finance the purchase of the 70s, and we took in a credit of 140. Now this is a little bit of a different trade because we didn't take in half the width of the strikes, and that's usually what we like to do on a debit spread. But in this case, since we wanted to gain some exposure in long positive deltas for our March portfolio, which is still very, very tilted towards the bearish side, we wanted to quickly add some of that into the portfolio. And Facebook just was a really good option today because it was very highly traded. It was breaking new highs, so if the market does continue higher, I'm sure this is going to be one of the first stocks to go forward and kind of lead the market higher, which would only help kind of soften the blow with the rest of the positions that we do have on right now. Now for Facebook, since we bought it the 70, 72.5, and we paid $1.40, that means that our break-even price is 70, which is that first strike here, plus the debit that we paid. So our break-even price is 71.40. Now if I actually go to the chart of Facebook today, you'll see that we actually have a good amount of distance between ourselves and our break-even point, about 30 cents right now, which is not too bad. And so we have a good distance between ourselves and the break-even point. And that's really what we want to do at the end of the day, is get in there, give ourselves a little bit of room. There's not too much room, especially with a $70 stock. It's not a huge amount of room, but you see that Facebook is right on the edge of breaking out to new highs. So even if the market does continue higher, this is one of those ones that's going to really help us out on the top side as it moves higher. Now, implied volatility was lower, so we didn't need to sell a credit spread. We just really wanted to take advantage of the positive delta that we could get by adding it to the March portfolio. The second option that we traded here today, or the second spread that we traded, was that we sold 8 verticals on C, which is Citigroup. Now we're coming back to the well here with Citigroup, made some great money on it last month trading a call debit spread, and now we're selling a put spread on it. Again, adding some of that long beta, long delta to our portfolio. We sold the 48.47 spread for 31 cents, which is right about where we want to sell our spreads for on the credit side, with the strikes about $1 wide. So we sold it for 1/3 the width of the strikes. And so what that means is that we're actually trading for about 70% odds of success right now, with a 30% chance of losing money on this trade. 70% odds of success, 30% chance of losing, adding to our portfolio beta on the positive side, made this a really good trade. So if we go to the chart of Citi, you can see here where Citi has been over the last couple of months. Obviously, the most important factor is this yellow IV percentile up in the top left-hand corner of the screen. It's at 56. So implied volatility is above the 50th percentile that we talk about. And it doesn't matter then if you trade the call spread above the market, and I think those were pricing up around 52, 51, or you trade the put side below the market where we traded at 48, 47. It really does not matter at all which side of the market you trade, so long as you actually trade the right side of implied volatility. So I get the question all the time is, Kirk, why'd you choose the bullish side, or why'd you choose the put spread over the call spread? And really it just came down to a function of we needed some bullish trades in our portfolio. We have a lot of bearish trades. We have some bullish trades, obviously, but we need a lot more bullish trades to kind of even us out and neutralize our portfolio heading into April. And so we just needed some put spreads on the other side. I could have easily gone to the call side if my assumption was that Citi was going to go down. So it doesn't matter what your assumption is. You can trade either direction. But the key here is that this implied volatility, you got to be on the right side of that. You don't want to be buying options when implied volatility is high. You don't want to be selling options when implied volatility is really low. Just to kind of drive home this point, I want to go to the actual trade tab here of Citi, just so you guys can see exactly where our position is. And you'll see down in the bottom left-hand corner of your screen, as always, we have our position in Citi, which is here. So we're up about 20 bucks on the day, so not too bad, and really just a very small position. But you'll notice where our strikes are at the 48 and 47 level. It's right at about the 35th percentile here. So that means that the probability of making money or losing money on this trade is 70% chance of success, about a 30% chance of losing. If you wanted to go to the top side, so if you were bearish on Citi and you thought it was going to go lower, then all you do is find your probability here that you want to trade on the top side with the calls. So let's say you want to trade this probability level here at 23. So you want to trade with 80% chance of success and a 20% chance of losing, 23% chance of losing. Then you would go ahead and sell the 52.5, 55 call spread above the market. And so you'd be quite a big distance away from the market already, given that the market's at 49.5. So you'd already be quite a big distance away from the market already. And that's why you're taking in less premium, but also have a higher chance of success because you're already further from the market. So you can see it doesn't matter which side of the market you trade. It really depends on your underlying assumption. Are you bearish? Are you bullish? Are you neutral? Do you need positive delta? Do you need positive theta? What does your portfolio look like, and what does that position fit into, or how does that position fit into the overall portfolio? That's obviously more of a bigger question than just trading the right side of the market. Yeah, it's great to be on the right side of a winning trade, but it sure is better to have a couple of trades that lose and then have some more trades that win because you're evened out and neutral in your deltas throughout the month. So hopefully that was a really good example of why we traded one side versus the other. I know that's a question I get a lot. I get a lot of my coaching calls with coaching students that I have right now. So wanted to really drive home that point since we only had a couple trades here today. Figured that would help out. So as always, I hope you guys really enjoy these videos. If you're watching this on YouTube publicly, you have to understand that this video is going out to our members the same day that the trading alerts go out. So if you're seeing this online, anywhere except for Option Alpha, then you're getting this video about 7 to 10 days after we make our trades. So if you want to get these trading alerts for free, you can sign up for a 7-day free pass. You get everything we have here. You get these video alerts, you get the text alerts, the email alerts, you get everything for 7 days at optionalpha.com. As always, if you have any comments or questions, please add them below this video. I'll get back to all those questions tonight or tomorrow before the open, and happy trading.